In the spring of 2026, the Strait of Hormuz closed. Missiles traded airspace with commercial drones, and the maritime chokepoint handling a massive fraction of the world's energy simply stopped functioning. Global trade ground to a halt. When supply chains snap and markets plummet during a geopolitical shock like this, the immediate retail reaction is panic. Everyday investors look at their portfolios and assume that trillions of dollars in value are simply evaporating into thin air. Wealth does not evaporate during these events, it rotates. Capital systematically drains out of vulnerable, consumer-dependent sectors and floods directly into secure, scarcity-driven assets. We call this process wealth rotation. Institutional capital follows a predictable, repeatable playbook during these crises, a pattern established across 50 years of macroeconomic data, stretching back to the 1973 oil embargo. Surviving an energy war requires ignoring the retail panic and tracking the institutional smart money across a specific 5-step defensive playbook. Step 1 begins at the source of the shock. When the Strait of Hormuz is compromised, roughly 20% of the global supply of crude oil and liquefied natural gas is instantly cut off from the market. This chart shows the historical price of West Texas Intermediate crude oil. The extreme vertical spikes perfectly align with historical shock periods and recessions. That physical shortage transforms energy equities from sluggish market laggards into a defensive hedge. Then comes the secondary ripple effect, the logistical bottleneck. Commercial ships are forced to abandon their standard, highly optimized transit lanes to avoid the conflict zone, adding thousands of miles to their journey. Because every ship is taking weeks longer to complete a single delivery, the global market suffers an immediate shortage of available vessels. With capacity stretched to the breaking point, global freight and shipping rates explode overnight. In response, smart money rotates into dry bulk and tanker shipping equities. They buy the companies that own the boats, capturing that massive, war-driven logistics premium. The first phase of wealth rotation exploits the physical realities of supply and distance. If it costs exponentially more to move goods across an ocean, the companies moving them hoard the wealth. From corporate logistics, the rotation moves to the state level. Major geopolitical conflicts force NATO countries to reevaluate their security, leading to large, multi-year increases in their national defense budgets. We see economies shifting from a baseline target of 2% of their GDP dedicated to defense, pushing toward a 5% mandate. That is a massive reallocation of public funds. Capital rotates into aerospace and defense contractors to capture this spend. Unlike volatile consumer markets, defense revenues are locked in by multi-year, guaranteed government contracts. Meanwhile, the broader economy feels the burn. Expensive energy makes manufacturing and transporting basic goods more expensive, which triggers systemic inflation. This inflation erodes the purchasing power of fiat currencies like the US dollar, making cash a liability. Institutional capital begins leaving the currency markets entirely. They seek refuge in hard assets. Gold and commodity-backed currencies become the primary safe havens, utilized specifically to preserve purchasing power during stagflationary periods. By the end of Phase 2, institutional money has abandoned consumer risk. It shelters in assets immune to drops in consumer spending, state warfare contracts, and raw precious metals. Finally, we have to look at geographic divergence. Global energy shocks do not damage all national economies equally. This graph shows oil shock effects on regional GDP. The solid black line, Germany, shows energy-dependent nations suffering massive capital drains. The dashed line, the United States, shows capital rotating directly into net energy exporters, padding their baselines. The United States, along with resource-rich nations in the global south, absorb this cross-border capital flight. National borders dictate survival in a crisis. Wealth rotates out of economies that must buy energy and settles into the economies that own it. The global market is ultimately a rigidly closed system where energy directly dictates the flow of capital and wealth. The 2026 crisis accelerates a structural move toward regional fragmentation. As industrial bases leave energy-dependent regions for resource-owning nations, the previous model of a single, frictionless global market ends. Systemic wealth is now dictated by the control of raw physical resources and the military logistics required to protect them. While retail investors sit paralyzed, waiting for the old world to return, the smart money has already finished rotating into this new order. History shows that these conflicts reallocate capital away from consumers and toward resource owners. To stay ahead of the next rotation, hit subscribe and join us next week as we break down the $1.8 trillion private credit market, a ticking time bomb waiting for the next macro